What that means is the following. In terms of our forecast, we look at Ohio wage and salary income over fiscal year 10 and 11. Instead of seeing, now the red line shows you where we were in September, the green line shows you what we are forecasting now. Okay, so we are looking at deterioration over 10 weeks. Now, what you can see here is in September, we had anticipated about a $25 billion increase in wage and salary income. Our consensus forecast now predicts a $600 million loss in wage and salary income over the same period. Let's look at disposable personal income. This counts equity earnings on bonds and stocks, rental income, and other sources of passive income. And here again, you can see our fundamental numbers are looking poorer than they did before over fiscal year 10 and 11. Instead of a $41 billion increase in disposable personal income, which is what we were predicting, in September, we're now seeing a $19 billion increase, which is about a 50% reduction in the rate of growth in disposable personal income. So what is our conclusion? Over the past 10 weeks, over $2.6 billion in forecast GRF revenues have evaporated because of what we are seeing happen around us in the national economy. Now, how's this shown on this chart? What we've shown you is the blue bars is our forecast revenues in September as we were beginning to put together the budget, and we had met the last time with the Council of Economic Advisors. The purple bars on the right side show you where we think we are now and what we're looking into for the next biennium. And the total change is $2.6 billion. So those are significant numbers. The question we must ask is, what are we looking into in the future? So let me describe to you a little bit about what we think we are looking into over the next 2 years. We have developed 3 scenarios. Those of you that were before us the last time we did this in February of last year, we laid out for you 3 scenarios. You will recall one of them, which was the best one, was a low growth scenario. And we had a medium forecast which showed you a 0 growth scenario. And the last one was a full recessionary scenario. And the conditions of that full recessionary scenario are what you see before you in the left-hand column of this chart. It is the recession scenario, and that is where we are today. And in that recession scenario, we predicted a mild recession of 2 quarters, that wage and salary would decline somewhat and then recover by the 3rd quarter of 2010. We thought there would be no further disruptions in credit markets, and credit would begin to ease significantly. And we thought we would see a recovery in the 3rd or 4th quarter of calendar year 2009. So the right 3 columns of the chart before you show you what we think is ahead of us. So the first scenario is our most optimistic one. That rather than a mild recession of 2 quarters, we are looking at a conventional 18 to 24 month recession. A deeper recession lasting into calendar year 2010, with deeper disruptions in our labor markets and sustained unemployment rates at U.S. rates, a modest decrease in consumer demand, soft credit markets. So credit is difficult, more difficult, but not impossible to get. Gross state product growth is still below trend, and there would be no appreciable growth in the Ohio economy over the biennium. The B scenario is our mid-level scenario, an extended consumer-led recession. This would be an extended recession with negative real gross state product throughout fiscal year 2008 in 2009. Our labor markets will contract consistently over a 3-year period, 2008 to 2011. And consumer confidence and spending would continue to slide through 2010. And in this scenario, we assume the automotive sector will remain in an extended decline. The final scenario we've come up with is a more difficult one, a severe manufacturing and financial sector contraction. This would be a prolonged and deep recession lasting well into 2011. There would be a continued freeze in credit markets, making credit difficult to obtain for most commercial enterprises, state and local governments, and a severe contraction of manufacturing and the financial service sector, leading to widespread and long-term reductions in Ohio's labor market.